Welcome to the deep dive. Today, we're cutting through the noise to chart the course for the crypto market in 2025.
Yeah.
We've got a stack of research that really lays out what's coming, from these huge market-moving events to the quieter foundational shifts happening behind the scenes.
Mm-hmm.
Our mission basically give you the fast track to being truly well-informed about the opportunities, the challenges ahead. We're boiling down the most important insights.
Right.
We'll explore the monumental Bitcoin halving, dive into a fascinating project making serious waves, Chainlink, and connect it all to the broader economic forces at play.
And what's truly fascinating here, I think, is how these seemingly separate things, you've got a pre-programmed event like the halving, then this infrastructure project like Chainlink just expanding like crazy, and global economic conditions, how they're all sort of converging.
Right.
To potentially reshape the entire crypto landscape. So we're looking not just at what's happening, but really why it matters for you and, the broader financial world.
Okay, so let's kick things off with the big one. The event everyone's watching, the Bitcoin halving of 2025.
Main event, yeah.
For anyone who might be new to this, it happens roughly every 4 years, or more precisely, every 210,000 blocks. And what happens is simple, but, pretty profound. The reward for mining a Bitcoin block gets cut in half.
Right.
So before this 2025 halving, miners get 3.125 Bitcoin per block. Afterwards, that drops to just 1.5625 Bitcoin.
And this creates what people call a supply shock. Just think about it. The daily Bitcoin hitting the market drops like instantly from 900 Bitcoin a day down to 450.
Wow, cut in half.
Exactly. And this fundamentally makes Bitcoin even more deflationary. Its supply growth slows right down. The inflation rate actually drops to about 0.4%.
Okay.
Which, just for context, is lower than gold's inflation rate of around 1.6%.
Interesting comparison.
Yeah. And for miners, this forces them to adapt. They either need to get way more efficient, upgrade their gear, or they need a significantly higher Bitcoin price to stay profitable.
Okay, here's where it gets really interesting for this cycle, though. Because this halving, it feels fundamentally different, doesn't it?
It does. There's more going on.
While these events always cause a stir, our sources are pointing to, 3 key things that make 2025's halving potentially much bigger. First, institutional adoption. It's at levels we've just never seen before.
Right. The ETFs changed the game.
Exactly. We're talking the big players, traditional banks, investment funds. They're not just watching anymore, they're actively buying in, especially through Bitcoin ETFs, which, let people invest via their normal stock accounts.
Yeah, easy access.
Second, altcoins have really matured. They're showing real-world use cases now in DeFi, AI, real-world assets, RWAs. It's not just theory.
Practical applications are finally emerging.
And third, the whole macroeconomic picture. Potential rate cuts, maybe some dollar weakness. That could really supercharge the whole crypto market, right? Inject a fresh wave of cash.
Absolutely. That liquidity factor is huge. And historically, past halvings, the price gains were just staggering.
Yeah, tell me about it.
In 2012, Bitcoin did a 95x gain. Jumped from $12 to $1,150.
Incredible.
After 2016. 30x. From $650 up to $20,000.
I remember that 20K peak felt insane at the time.
Right. And then 2020, it was an 8x gain. It's roughly $8,500 to $69,000.
Still massive.
It really puts these future projections into perspective. If history kind of rhymes, Bitcoin usually peaks maybe 12 to 18 months after the halving event itself.
Okay, so not immediately.
Not usually, no. Conservative projections for this cycle.
Yeah.
Maybe $150,000 to $250,000. More bullish cases push it past 300K, especially with continued ETF inflows and broader adoption.
That 8x gain in 2020, it sounds amazing, but it also makes me wonder, with all this institutional money coming in now, could we actually see less volatility, or will it just make the swings even bigger?
That's the million-dollar question, isn't it? More stability or more fuel? Hard to say for sure.
And it's not just Bitcoin that's looking interesting. There's this strong theory, right, that after Bitcoin dominance peaks post-halving, the money rotates into altcoins.
Yeah, the alt season narrative.
Leading to what some call an altcoin explosion. Bitcoin dominance, which is just, Bitcoin's market share compared to everything else, often acts as a signal.
A key indicator people watch is when BTC dominance drops below 40%. That often signals money flowing outwards.
And a potential catalyst here could be the Ethereum ETF effect. If a spot ETH ETF gets approved, likely sometime in 2025.
Which seems increasingly probable.
That could trigger a, quote, liquidity tsunami for altcoins. institutions might start diversifying into things like Solana, XRP, Cardano, maybe even newer sectors.
Exactly. And that brings us to these new narratives, new millionaires' ideas.
Right. Like what?
Well, AI tokens, for one. Things like FET, AGIX, RNDR. They're at that intersection of AI and blockchain, decentralized computing power, that kind of thing. Then there's depenery, decentralized physical infrastructure networks. Projects like HNT or IOTX building out community-run networks, wireless hotspots, sensor data, things like that.
Physical infrastructure meets crypto. Interesting.
And RWA's real-world assets, like Ondo, token. Literally putting things like real estate or treasury bills onto the blockchain as tokens.
Bridging the old and new finance worlds.
Precisely. And, well, you can't ignore meme coins. For better or worse, there's still those retail FOMO plays with huge viral potential.
Always a wild card. So with all this potential energy building up, how should someone listening approach this? What does this mean for let's say, a smart portfolio strategy?
Yeah, strategy is absolutely key here. You can't just jump in blindly. Our sources suggest breaking it down into maybe 3 phases.
Okay. Phase 1.
Phase 1, pre-halving. That's basically now until early 2025. The thinking here is more conservative allocation, maybe 60% Bitcoin is the safer foundational play.
Got it.
Then maybe 30% in what you'd call blue chip alts, Ethereum, Solana, BNB, the established players.
Yeah.
And then leave about 10% for higher risk, higher reward stuff, low cap gems with strong narratives, things that could really pop. The idea is secure your core Bitcoin position, get some exposure to promising alts before things potentially take off.
Makes sense. And phase 2?
Phase 2, having to peak. This is typically Q2 2025 through to maybe Q3 2026, based on past cycles. Here, the strategy shifts. It's about taking profits and rotating.
Rotating out of Bitcoin.
Taking some Bitcoin profits, yeah. Maybe 20, 30% at different price points. Say $150K, $200, whatever your targets are.
Okay. And rotating into?
Into those leading altcoin sectors that are showing strength. The reason is, once Bitcoin makes its big initial moves, money often flows into alts looking for those higher percentage gains.
Chasing the next pump.
Sort of, yeah. And for those alts, the advice is usually to stagger your exits. Don't try to sell the exact top. Sell portions at maybe 2x, 5x, 10x gains as they hit their highs. Lock in profits along the way.
Right, don't get too greedy. And the final phase?
Phase 3, market top. This is when you see clear signs of euphoria. Crypto's all over mainstream news. Your taxi driver's talking about it. Meme coins are doing 100x.
The to the moon tweets everywhere.
Exactly. Irrational exuberance. The action here is tough, but critical. Secure your profits. Move into stable coins. Get ready to buy back when the bear market eventually hits.
Recognize the peak psychology and act against the herd.
That's the key insight. Act when others are most emotional, most euphoric.
Okay, this all sounds incredibly promising, but we have to look at the other side. What are the big risks? What could derail these projections?
That's crucial. You're right. There are definitely headwinds. Regulation is always a big one, particularly potential SEC actions against specific altcoins. That could create a lot of uncertainty, maybe even delistings.
Yeah, regulatory clouds are always hanging over crypto.
Then macroeconomic shocks, an unexpected recession, some major geopolitical event. Those can change market sentiment really fast, lead to a broad risk-off move away from assets like crypto. And finally, just over-leveraging within the crypto market itself. Liquidations can spike, especially around volatile periods like the halving, and that can cascade, impacting stability, particularly if there's a sharp downturn.
Right. Those leverage cascades can be brutal. Now, speaking of those emerging sectors like RWAs, let's zoom in on a project that seems to be, building the actual infrastructure for it, Chainlink.
Yes, Chainlink.
Our sources pointed out something striking. On a day, the whole crypto market cap dropped like $71 billion because of some geopolitical news. Chainlink actually grew 9%.
That is a powerful signal. It shows real investor confidence in its fundamentals, even when the broader market is spooked.
So what's driving that? What's fueling this resilience and rally for Link?
Well, several things. First, there's significant whale accumulation. Big investors are buying and holding on Link, reducing the freely circulating supply. That usually signals strong belief in the long term.
Okay, the smart money is moving in.
Then there's just relentless institutional adoption and partnerships. Chainlink partnered with ICE, the parent company of the NYSE, for Forex and metals data.
Wow, NYSE's parent company.
Yeah, and collaborations with Visa, ANZ Bank, China AMC, Fidelity International for cross-chain settlements, MasterCard too. These aren't small deals. They're building crucial bridges between traditional finance TradFi and blockchain.
Enabling data and value flow.
Exactly. And their total value secured, or TVS, basically how much value relies on Chainlink oracles, hit an all-time high of $93 billion.
$93 billion. That's huge.
It really underscores how deeply embedded Chainlink is becoming in DeFi and beyond. Plus, it's not just talk. They rank #1 in development activity among Ethereum projects, according to Santiment recently. Lots of building happening.
So with all this momentum, what's the technical picture look like? Where could it be heading, especially given its role as this key infrastructure?
Well, as of late August 2025, LNK was trading around $26. Market cap about $17 billion, ranked #11. Short-term targets analysts are watching are in that $26-30 range. Longer term, some projections see it hitting $47, maybe even $100 or more in this cycle. There was even a prediction by Ash Crypto on X suggesting Chainlink's CCIP, that's their Cross-Chain Interoperability Protocol.
The tech that connects blockchains.
Right. He predicted it could become a global standard, like TCP/IP or HTTP for the internet. If that happens, obviously the value implications are massive. It becomes the internet of value.
A global standard. That's a huge claim. It really makes you think about how Chainlink is enabling that RWA tokenization we mentioned. It really does sound like the backbone for bringing TradFi onto the blockchain.
That's exactly the role it's playing. It's the secure middleware, the secure way to get real-world data onto blockchains and connect different systems. They even launched a Chainlink Reserve program specifically to boost tokenized asset growth and cement themselves as the standard.
So they're actively trying to become that standard.
Definitely. And their ecosystem's just exploding. 12 new integrations across 10 different blockchains recently, Arbitrum, Avalanche, Base, Solana, strengthening that CCIP network effect. Plus, new services, data feeds, data streams for real-time stock data like Apple and NVIDIA, on-chain NAV for funds, proof of reserve for transparency.
Proof of reserve sounds important for regulation.
Hugely important. Verifiable proof of off-chain assets. It builds trust.
And the co-founder, Sergey Nazarov, he has this big vision, right? Calling this the final stage of blockchain adoption. What does he actually mean by that?
He does, and it's quite compelling. Yeah. Nazarov sees DeFi and traditional capital markets really merging, not just coexisting, but forming a single internet of contracts. He thinks clearer U.S. regulation is helping drive this.
Interesting. So regulation as an enabler, in his view.
In this context, yes.
Yeah.
And he believes 2025 is laying the groundwork for governments and central banks to actually adopt blockchain tech.
Yeah.
Moving it from a niche thing to truly global systemic infrastructure. That's the final stage he talks about. And at their SmartCon event, they introduced the Chainlink Runtime Environment, CRE. It's expected to be generally available in 2025. Think of CRE like a specialized operating system for really complex smart contracts.
More than just simple transactions.
Way more. CRE lets contracts pull in live market data, verify identities across different chains, even interact securely with traditional bank systems, all within one multi-step transaction. It bridges the gap between simple crypto apps and sophisticated real-world financial services.
That sounds like a critical piece of the puzzle for mainstream adoption. So, okay, incredible growth, huge vision, but Chainlink has faced criticism before, right? Things like tokenomics. What are the challenges or concerns still facing them?
That's a fair point. It's not all smooth sailing. Tokenomics and scalability are still discussed a lot in the community. As adoption grows, can the system handle the load without latency becoming an issue? And are the economics, the LNK token, truly sustainable long-term, even with all the integrations? Those are open questions.
Right. The tech needs to keep up and the economics need to work.
Exactly. Also, some network activity metrics, if you dig deeper, have actually declined in certain areas. That leads some to ask if the recent price rally is more driven by those whales speculating rather than purely organic growth from developers and users.
Speculation versus fundamental demand, a classic crypto question.
Indeed. And finally, competition. Chainlink is the leader, no doubt, but others like Band Protocol and API3 are trying to chip away at their market share. They need to keep innovating to stay ahead.
Okay, so challenges remain. Now, stepping back again, beyond these crypto-specific things, we have to talk about the broader economic currents. How do these big macro factors really influence crypto heading into 2025? It's not just an isolated system, is it?
Not at all. The crypto market's path in 2025 is deeply, deeply tied to global economic forces. These factors often set the overall mood, the risk appetite for investors.
Okay, like what specifically?
First, inflation and interest rates. They're critical. If inflation comes down, central banks, especially the US Fed, are likely to cut interest rates. That generally increases liquidity, makes money cheaper to borrow, and some of that excess cash often flows into riskier assets, like crypto. It can really fuel altcoin rallies.
And the reverse, high inflation.
Persistent high inflation could mean rates stay high or even go higher. That tightens liquidity, makes investors more cautious, and could lead to price declines. Risk-off behavior.
Got it. What else?
The regulatory landscape. We touched on it with Chainlink, but it's huge for the whole market. Clear, consistent rules, that builds confidence, especially for institutions.
Makes sense.
Restrictive policies or just continued uncertainty can really stifle growth. What happens in the US, Europe, maybe India's upcoming framework, it all matters. There's even chatter about how, say, a potential Trump administration might bring a different, maybe more favorable regulatory approach in the US.
Politics and policy playing a big role.
Always. Then there's the actual flow of institutional investments. More crypto funds, the ETFs we talked about, more tokenization of traditional assets. All this brings in serious capital and provides a more stable foundation for the market, especially for altcoins needing liquidity to grow.
So institutions provide ballast, potentially.
Potentially, yes. Also, the overall global economic health. It's a bit of a double-edged sword. Weak traditional markets. Sometimes investors turn to crypto as an alternative or a hedge.
A safe haven. Or just something different.
Maybe less safe haven, more non-correlated asset, historically, but a severe global downturn. That tightens everyone's belts, makes it harder to find buyers, especially for less liquid altcoins.
Yeah.
Exits can become difficult.
Okay.
Conversely, a healthy, growing global economy generally helps crypto. Investors feel more comfortable taking risks.
Makes sense. And lastly,
just geopolitical events. They can hit sentiment instantly. Our sources mentioned things like Trump's trade tariffs or that Trump-Putin meeting causing market jitters. It just shows how sensitive crypto still is to global uncertainty and risk aversion. It doesn't operate in a vacuum.
Absolutely not. Okay, so wrapping this up. What does all of this really mean for you listening in as we look ahead? 2025, it's shaping up to be, well, pretty consequential for crypto.
Definitely feels that way.
We've seen how the Bitcoin halving, this time with unprecedented institutional interest and a maturing altcoin market, really sets the stage for potential explosive growth. And how foundational projects like Chainlink aren't just, riding the wave, but actively building the pipes, the infrastructure for a future where TradFi and DeFi don't just coexist, they actually converge.
And if you connect that to the really big picture, think about this. The path for blockchain, shown by what Chainlink is building, it isn't just about finance, narrowly defined. It's moving towards government use, widespread adoption, where blockchains, oracle networks like Chainlink, smart contracts, they become the standard way to secure value, move data reliably, prove who you are for all sorts of transactions globally.
It's about trust infrastructure, really.
Exactly. It's bigger than just your portfolio. It's about the fundamental fabric of how trusted information and value move around the world in the future.
So the final thought to leave you with.
What does this really mean for the next wave of global financial innovation? And maybe more profoundly, how will it reshape not just our investments, but the very nature of trusted transactions worldwide?